Good morning to all our viewers. My name is Rocco Panzarino. I'm one of the senior account managers here at Maqro, and I'm joined by Brodie Harold, a private clients dealer from our wealth division. How are you today, Brodie?
I'm good, thanks, Rocco. How are you doing?
I'm good, thank you. So today we'll be discussing the strategies that we've implemented in this current rising interest rate environment, as well as how to identify stocks that will benefit under such circumstances. So just a disclaimer to begin before we commence. The economic and market overview is presented as purely factual information and should not be taken as advice. The model portfolios and hedging strategies are purely general advice in nature and does not take into account the personal objectives, financial situation, or the needs of the investor. You should consider whether the information is appropriate to your needs and, where appropriate, seek professional advice from a financial advisor. We also have a question tab up at the moment, so if anyone has any questions throughout the webinar, feel free to send them through and we'll answer them at the conclusion of the presentation. All right, let's get into things. I'll be talking about growth versus value stocks and the institutional shift away from growth that occurred earlier in the year and what the market is favoring at the moment and why. Brodie will then follow on to the performance of certain sectors and businesses as funding has essentially become more expensive. So lastly, we'll then go into some of the capital preservation approaches, what to stay away from to best protect your equity. So firstly, interest rates or monetary policy is a recurring theme prevalent in the current market. Just recently on Tuesday, the RBA raised the official cash rate by 50 basis points to 1.35%. Now, as a result of previous hikes, the market has altered significantly, which in turn has prompted institutions to change their focus in specific investment areas as well. At a fundamental level, this shift in focus is due to the fact that we see interest rates affecting the real economy while also having a key role in company valuations. So growth stocks are stocks that are valued on higher growth multiples because of the industry they're operating in or their potential for a rapid upscale in earnings and value. We saw this in companies such as Afterpay and Zip in recent years. On the other hand, though, value stocks are classified as companies that are currently trading on relatively lower multiples because there is less potential for growth, usually because they're well-established and larger companies. So examples of this would be Maqro Group and Woolworths. As you can see in the graph, this is the annual performance gap between the US Large Growth Index versus the US Large Cap Value Index, with growth being on the bottom side of the graph and value on top. So after 5 consecutive years of growth outperforming value, we can see that the beaten up value firms have outspaced growth stocks by a massive 22% in the first half of 2022, which is the second largest difference we've actually seen in 50 years. So why do you think this is, Brodie?
Yeah, it's a good question, Rocco. I think it has a strong correlation with the bond yields rising as well. So I think particularly at the start of this year, quite a lot of the price action that we've seen, it's been quite a lot of that institutional flow rotating out of growth and into more sort of bonds and safer investments, I guess you could say as well. So obviously those institutions, they're trading in much higher volumes. I think if you're a retail investor, you're looking to invest some money, making a couple of % on a bond each year isn't probably going to do it for you. But obviously, if you're trading in those much higher volumes, a couple of % each year, it's definitely worthwhile as well. So they're just de-risking their portfolios. I think there's a lot of chat about the upcoming recession. It's priced in around 40% to happen as well. So yeah, obviously those institutions would like to de-risk their portfolios. Great way of doing that is selling out of growth names, rotating into bonds, rotating into, I guess, yet less volatile larger cap stocks as well.
No worries. So we'll move on now. So the first trading day of the year coincided with near all-time market highs. So at around that same time, bond yields started approaching that 2% mark, which is a recognized level for, say, insurance companies, super funds, and hedge funds to rotate some of their growth holdings into value names and or subsequently start investing into bonds, as you said. So, Brodie, did you yourself notice some lower volume changes through these growth companies as the year progressed?
Yeah, I was monitoring volumes quite closely at the time. I think it's pretty important to do so. I think the movement was definitely more pronounced over in the US markets than here domestically, but we definitely saw a shift downwards in volume levels. So it all kind of lined up. I think the first day of the year, exactly like you said, we were very close to those all-time highs. I think the early selling off period that we had can be quite a lot sort of attributed to institutions selling those growth names, as I was saying before. So obviously bond yields rising up to that level, the institutions, they want to sell out of those growth names first and foremost, and then look to rotate into those bonds. So after that original sell-off, we did have a bit of a counterback rally. I noticed that as we were getting higher and higher in the market, the volumes were coming down, and that credit spread was getting thinner. So that's usually the credit spread, just for context there. That's a good indication that institutions are not buying stocks. They're actually going ahead and buying bonds instead as well. So that's something we definitely noticed at the time. It's usually a pretty good indication for us to get into a fair amount of cash, right?
Yeah, that's right. So we also understand that bond yields try to predict future interest rates. So when interest rates are higher, growth valuations change. Afterpay, for example, may have been at 100 times growth multiple, although when interest rates increase, access to funding became more limited, and as a result, their borrowing or funding costs became much more expensive. As a result of this, growth forecasts and valuations change, which is why we've seen brokers broadly downgrade growth stocks this year as well. So this record period of ultra-low funding is particularly new for investors. It's a standout period which some of the market has referred to as easy or free money. It's actually the lowest we've had since the 1970s. So as these larger institutions have rotated out of these growth names, not only does that sell down the stocks, but it also creates more volatility in those stocks due to there being less institutional flow. Now, what we've found is that stocks with strong institutional flow will have a stronger support and resistance points. For an idea of how this works, we can take a look at the ASX 200 VIX chart over the past year. So this volatility index provides an insight into investor sentiment, as well as expected levels of market volatility. This index tracks the ASX 200 prices as a means of monitoring anticipated levels of near-term volatility in the Australian equity market. So a high VIX would indicate that the market is expecting significant shifts in the value of ASX shares, whether that be up or down. Now, in contrast, a lower VIX indicates investors are expecting things to more or less carry on as they are, and moves in the share market should be much less defined. So it's quite evident that we are experiencing heightened volatility since the beginning of the calendar year. So in the next few slides, Brodie will be delving into some of the recommendations that we have in our active model portfolios. So Brodie, the first company we have here is Challenger. So what can you tell me about it? What makes it a beneficiary of the current economic climate?
Yeah, look, I think it's a very interesting point that you brought up. So obviously talking about the volatility index, I've had a lot more clients come up to me and say, where do we park capital at the moment? Things are very, very uncertain at the moment, as shown by that volatility index. Moves in the market are very, very pronounced. So we're very selective in terms of the industries that we want to go into. Challenger's a really good name. We've been involved with since the start of the year as well. They're definitely a beneficiary of this current economic environment. So just to provide context, if you don't know of Challenger, they're an Aussie fund manager. What they specialise in is creating and selling annuities. So they sort of focus in fixed income in particular. So they're the facilitator that sells bonds. So if you look at it from this way, if bond yields rise, they become a far more attractive investment for people. If you're getting, say, 1% on a bond per annum, it's not a very attractive investment. You can probably look elsewhere for that capital as well. But as soon as those yields rise and rise and rise, they become far more attractive. Therefore, more people buy them, which is a great thing for Challenger because they're obviously the company that sells them. So they make more straight away from facilitating that share purchase. And we've seen this in I think particularly with Challenger, if you look at the share price, going back a little bit further, almost back to the start of 2018, I think you've sort of seen that the business has struggled for some time. And that's because rates have been on this downgrade cycle. So their margins were just getting sort of thinner and thinner and thinner, and that reflected in the share price. But now we've had this rotation in economic environment. We're going the exact opposite way, Rocco. So where expectations are being lifted, this is good for the share price as well. And we've sort of seen this in the movement. It's been relatively stable ever since COVID. It had that original dip as well. And I think if you're looking at sort of when we got involved in the position, it was quite a good time. That's why you've sort of seen that outperformance compared to the market, because the very thing that is hurting the market at the start of this year benefits Challenger. So that's why we were sort of looking to get involved at that period of time, and it's paid off for us. Look, we're only up around 2% on the position, but I think given what the market has done, just to get a name that's that stable and has been able to outperform the market by close to 15% in that period of time, has been really beneficial for us.
Excellent. Thanks for that, Brodie. Next up, we have QBE. So now, Brodie, can you explain how an insurance company specifically will benefit from these rising interest rates?
Yeah, look, it's a question I get asked quite a lot, Rocco. I think you've got to look a little bit further into the insurance company when you're looking at that question. So I think probably the biggest indication is a big proportion of insurers, their investments are in bonds, first and foremost. So when you pay your insurance, the companies, they don't just go and sort of put that money straight into the bank. They go out and invest it, which is probably why it's a little bit difficult to get money out of them in the first place. And they pick very low risk investments because of the nature of their business. So they'll basically go out and invest in bonds. So if the bonds themselves are starting to rise and rise and rise, well, that's fantastic for QBE, because not only are they getting the money through the door, their investments are making far more than they previously were. So that's almost just added revenue to their bottom line straight away. And I think there's also a couple of other factors that have been going on with QBE. So that was from an interest rate perspective, but also the valuations on properties have been much, much higher as the property prices have been rising over the past couple of years, and recent weather events as well. So these are all very great excuses for insurance companies to go out and raise their premiums. If they can go out, raise their premiums, that's more money through the door for them as well. So look, again, similar outperformance of the market through QBE from when we got involved with it. It's really managed to hold up, stay quite stable. ASX is down around sort of 13% mark, and QBE is sort of held up there as well. So I guess that's a lot about capital preservation. I think a dollar saved in this type of market condition is just as good as a dollar earned at the moment.
Yeah, exactly right. So lastly, we have elders. So we've seen agriculture favoured this calendar year as well, mainly due to rising commodity prices as a result of the geopolitical tension. So what's your thought on Elders, and why do you see this benefiting in the current environment that we're in?
Elders is a great company. Look, it's been around for a long, long time. I don't think people actually understand how diversified they are within the agricultural sector. So basically, it's quite simple. If agricultural does well domestically, Elders is sitting there and they're taking a clip on just about everything. So I think there's a lot of demand at the moment. The ongoing food crisis we've been seeing, that's been very much driven by supply chain issues across the world. Obviously, if it used to take a week to ship some food across from one country to another, and now it's taking a month, you're going to see this massive backlog in demand as well. So exactly like you say, Rocco, soft commodity prices have been strong because of this. Elders benefits from that. Rural property prices have been strong. Elders will benefit from that. Fertilizer demand is actually at extremely elevated levels where we stand at the moment. Elders will benefit from that. And just to go a little bit more into that point, so what we're seeing with the fertilizer demand is that quite a lot of these countries, if they wanted to, they could up their production of food in the first place. But you look at sort of Brazil is a really good example of this. I think it's the fourth largest food producer worldwide. So they can increase their food production, no problems with that. One of the biggest problems that they're seeing is they don't have the fertilizer there to be able to produce the food in the first place. So that's a big issue that's sort of holding back and making this issue even worse in the first place as well. So look, another benefit for Elders is obviously they've released a really strong report not too long ago. Share price has fallen off. I think that's just because of the market in general. It's realistically just fallen with the market. So I mean, if you're looking at it at the moment, I think it definitely presents a really good opportunity. It's a really good company in a good space, and it's proving that it's doing a good job as well.
Excellent. Well, that concludes us. So thank you all for your time joining our Maqro webinar. So we only did touch on a few recommendations today. We do cover 6 investment strategies in our research, which are investing, active, ESG, ETFs, small caps, and dividends. So if you'd like to find out more about our research or take advantage of this current deal, feel free to call our landline, which is on the screen, and be put through to the sales team, who would be more than happy to help and answer any questions that you may have. So we have had a couple of questions come through at the moment about bond yields specifically. So John's asked about bond yields. You'd like a little bit more context into them and the nature of them. So Brody?
Yeah, so bond yields are basically almost a predictive outlook on what interest rates will be in a certain sort of period of time as well. So we probably should have clarified that a little bit more. You'll get sort of 2-year bond yields, 5-year bond yields, 10-year bond yields. And basically what that does is they move, unlike interest rates, they move before interest rates. So what the market will try and do with these bonds is predict where interest rates are going to be in that 2-year period, in that sort of 3-year, 5-year, 10-year period as well. So every time, and then this is why it's really quite important as well, every time the Federal Reserve comes out or the RBA comes out and releases a statement about interest rates, even though they haven't necessarily made any changes, if they start to come a little bit more bearish or bullish, basically what we'll see is those bond yields rise or drop on the base of that as well. So yeah, look, that's a really good point. Bond yields obviously that sort of leading indicator of interest rates, and what they'll try and do is predict future interest rate hikes and price them in as much as possible as well. I hope that answers your question, John, a little bit better as well.
So we've had a question come in from Liam. He's asked, do you find any other names in the financial sector beneficial in the short term, or mainly just Challenger?
Challenge is definitely our preferred pick in the space. I think there's a lot of opportunity in the financials. They got sold down originally when the interest rates started to go up in the first place. So yeah, I think the banks are starting to look pretty interesting at this stage. They actually tend to benefit from interest rate hikes in the first place. So you'll get that original sell-off. They might not write as much business in the first place, but their margins will actually get larger as well. So obviously a lot of investors involved in the big 4 banks, if you saw them sell off recently, that's because of it. But they should tend to do well in the longer term.
Okay, we have a question from Bob. Do you think that our central bank is raising rates too fast, similar to the Fed?
It's a good question. I wouldn't like to be in their shoes at the moment. I think anything they do is going to come under criticism where they stand. I don't think so just yet. I think particularly, look, they're trying to front load those interest rates. They've made that very clear in the first place. So what they'll tend to do is they want to slow down the economy as quick as possible. So they'll front load those interest rates. They'll hit us with 3 very quick rate hikes, possibly even again in their next meeting as well. And what that'll do is it'll probably stamp out inflation quicker. So they're trying to sort of hit the problem very quickly. And if they can do that, then what that means is it reduces what we call the terminal rate. Rather than them going very, very slow, maybe going 25 basis points every meeting, that can take quite a while to actually have a trickle-down effect on the economy. So they try and do it firstly, hit it hard, and then what that means is they don't have to lift interest rates quite as high because it gets their desired effect straight away. So that's what we're seeing at the moment. Whether they're doing it too fast, look, it's a good question. We'll probably have to wait and see. But yeah, look, that's basically what they're trying to do at the moment. I don't necessarily think it's a bad thing. They just need to be careful with raising the rates too high. But they haven't done that quite yet at the moment.
All right, so again, thank you all for your time joining us here on our Maqro webinar. That concludes the presentation.